A solid U.S. economy or cuts to interest rates? Investors weighing which is more important. It was that batch of robust economic data that really is calling into question the need for looser Fed policy.
Hello and welcome to The Week Ahead on Nomura Podcasts. I'm your host, Andrew Tysas from our Global Markets Research team, and today's Friday, 26 September. As we head towards the end of the week, we've seen some perhaps more interesting than expected moves in markets this week, with Romain Bostic from Bloomberg there giving us a taste. We could perhaps summarise this as good news is bad news. Over prior weeks, Fed easing expectations appear to have been driving all markets, sending equities higher, credit spreads tighter, and the US dollar and US yields lower. But better US data this week have resulted in a little of those rate cut expectations being unwound, testing crowded positions and sending equities lower and US yields and the US dollar higher. Markets will be in for another big test next week with another US payrolls report eagerly awaited. The significant risk of a US government shutdown is approaching too, so this week we'll check in with our US research team to get some thoughts there. Hannah Liu from Nomura's China research team will be along to look at data out next week and the big picture there too. And I'll be checking in with Sonal Varma, our chief India and AEJ economist, to preview the Reserve Bank of India meeting next week. Finally, I'll take a quick look at activity data in Japan and touch on developments down under and what we expect from the Reserve Bank of Australia's policy meeting next week. Enough there to keep us busy, I think. So let's dive in. So let's go to the US. I'm delighted to be joined here by David Seif, Nomura's chief economist for developed markets and based in New York. David, welcome back to the podcast.
Great to be here. How are you?
Yeah, very well, thank you. I wanted to ask you about this US government shutdown story. How serious is this and how likely is this?
Well, first of all, it's quite likely at this point. I would say that as of Friday, the government shutdown is just a few days away, so it would begin just after midnight on Wednesday, October 1st. And the two sides are not talking. The House is not going to be in session prior to that date. So it's very hard to see how this isn't going to happen at this point. I mean, never say that never. So I wouldn't say there's more than, say, an 80% chance, but I certainly think it's far more likely than not that there is a shutdown. Now, this would be a pretty big government shutdown, what's called a quote-unquote total government shutdown, meaning that while essential workers could continue to stay in place, something like around 800,000 federal workers, basically in all agencies, ones that are not deemed essential, would be furloughed without pay indefinitely until the shutdown were to come to an end. In terms of the length of the shutdown, this doesn't seem like there's an easy off-ramp for anyone here. So, you think about, or you look at some of the past shutdowns, we had a 16-day complete government shutdown in 2013 and a 35-day, slightly more limited, but still major government shutdown in 2018 to 2019. And so this seems as though it could go on for weeks, and I certainly wouldn't put it past it to go on for a month.
Okay, got it. No easy off-ramp. I guess we'll have to keep a close eye on that one. Hey, the other big focus, of course, in the coming week is US payrolls data, possibly even more important than normal right now. What are you looking for in that report?
Yeah, well, the first thing before we get into what the report will say is when will it say it? So, of course, going back to the government shutdown, if there is a shutdown, almost certainly the vast majority of government data releases would not come out and would be delayed significantly. So that would almost certainly include the October 3rd payroll report would not actually come out on October 3rd. And quite frankly, it seems as though if the shutdown were even a few days long, more likely than not that the October 15th CPI report would not print as expected. So if we go back to 2013 and that shutdown, it was only a 16-day shutdown, still a significant period of time, but it was almost 2.5 months before the statistical agencies were back on track because they come back in, they've been out of work for over 2 weeks, and they have this backlog of work, and they can only process at a little bit faster than their normal speed. So it takes multiple times that time period to get back on track. So it was the middle of December in 2013 when they were finally back on track. That shutdown also began on October 1st. So we think it's more likely than not that we will not get that payroll report on October 3rd, although it, of course, will come out at some point. So nonetheless, we have the data that we would use to build our model for it. And we expect headline non-farm payrolls to rebound to 65,000 in September. So still pretty weak by the standards of the past couple of years, but significantly better than the past couple of months have been. We also think it's likely that there are going to be positive revisions to prior month. That's simply what has seasonally tended to occur with the September employment report, which typically comes out in early October. In terms of the unemployment rate, we think that it is going to be sideways at 4.3%. And the bottom line for us is that we expect this employment report to continue to show the dynamics that has characterized the U.S. labor market for really over a year now, which is pretty low hiring, but also very low levels of layoffs. So we see demand for new labor continuing to cool, but no spread of widespread layoffs. And that means in our mind that any rise in unemployment that we do see, not just in this report, but over the future, should remain gradual.
Okay, David, that's perfect. Thank you. Hope you have a great week ahead.
Thank you very much, Andrew.
Let's move to China. Hannah Lu from Nomura's research team in Hong Kong is here with us. Hannah, thanks for joining.
Hey, Andrew. Thank you so much for having me back.
Excellent. Our pleasure. Look, let's start with the data next week. What will you be watching?
Yeah, so starting from next Wednesday, actually, China kicks off its extra long 8-day Golden Week holiday. So we're going to brace for a quiet week on data front. But before that, we do have the PMI data on Tuesday. And for manufacturing PMI, we expect it to remain weak at 49.9 in September, unchanged from August. This is largely driven by the still lackluster leading indicators in the emerging sector PMIs, and also the ongoing anti-involution campaign and the payback effects from the consumer trade-in program. And on the other hand, for the non-manufacturing PMI, it's actually going to be quite okay. We expect it to hold steady at 50.3 in September, and this could be largely supported by the holiday effects, as well as some of the wealth effects from the recent stock market boom.
Okay, understood. Thank you. So that's the near term. Now, while we have you here, stepping back, let's look at the big picture. What are the implications of the sectoral tariffs on China's exports, and the overall economy?
Yeah, so this Friday, as we see from Trump's Truth Social, they U.S. imposed the tariffs on basically four sectors on all countries, and we actually believe the instant bite on China's export specifically is quite limited. This is based on two reasons. The first one is such tariffs, they are universal tariffs imposed on every country, not only just China. And the second reason is that the relative size, according to our estimate, is quite limited. And we actually just published a report on this. And according to our estimation, these related four sectors, including pharma, furniture, kitchen cabinets, and bathroom vanities, accounts for less than 2% of China's total exports to the US in 2024. And also taking a step back on the export sector overall, to be fair, export sector has been doing relatively well, at least relatively better than what we expected in Q3, with a solid growth about 5% between July and August. And on top of the export growth, I think U.S.-China tension could also likely get a temporary reprieve ahead of the Trump-Xi meeting in end October on the sidelines of the APEC meeting. But that said, this doesn't mean that the broad economy is off the hook. If we look at the consumption side, it's a whole different story. Here, I think it's worth to mention that we are just at the point to wrap up a full year of the durable goods trade-in stimulus. If we look at those leading indicators of some of the home appliance domestic sales, for example, if we look at the factory production plans for the washing machine, air conditioners, and refrigerators, they're all falling very sharply across the board. So this could imply that the durable goods sales is shifting from previously a growth tailwind to a headwind.
Okay, got it. So not off the hook just yet. Hannah, that's great. Thank you so much.
Thank you.
Now, let's move to the other really big player in the region, India. I'm joined here by Sonal Varma, Nomura's chief economist for India and AEJ. Hey, Sonal, thanks for making the time.
Hey, Andrew. Glad to be here.
Excellent. Thank you. Look, let's start with the Reserve Bank of India, RBI. There's a policy meeting out next week. What do you expect?
Yeah, so it's going to be an interesting meeting. We're expecting a surprise 25 basis point rate cut for various reasons. So GDP growth has surprised on the upside in Q2, but that's backward looking. And we think the 50% US tariff on India is a negative growth shock, and it'll more than offset the growth boost from lower GST rates. Inflation also provides a space. It's actually tracking over 1 percentage points below the RBI's 4% target. Policy rates are restrictive, real rates are high. And we also think from a timing perspective, an October rate cut makes more sense because this is typically the start of the busy credit season in India. So transmission, will basically happen right now. So we see both a need and the space to cut. Consensus expects rates on hold, but as we discussed, we think the meeting is live. So we're assigning a 70% probability to our baseline of a cut and 30% to a hold.
Okay, that will be an interesting one. Thank you for explaining all of that. Look, just looking at the broad Asia region while we have you here, probably fair to say that exports and growth have held up a bit better than many had expected through the first half. So I was hoping to ask you, how do you see growth momentum for the region over coming months?
Yeah, that's true. I think particularly post the April reciprocal tariff announcement, the growth numbers have surprised on the upside. And I think for many reasons, the ramp up in tariffs has been more gradual. Countries have benefited from front-loading and rerouting. And also the AI upcycle has been stronger than expected. But as we look forward, I would say we are starting to see the impact of tariffs in the August export data. So, 7th August is when the reciprocal tariff moved up from 10% baseline to 15 to 20% across a number of countries. So Asia's exports to the US are slowing down in the month of August. And as we look ahead, the China slowdown in second half, which is what Nomura expects, will also weigh on Asia's exports. We have the threat from multiple US tariffs in the pipeline. So pharmaceuticals was announced this week. Semiconductor and electronic tariffs are expected soon. Now, amidst all this, the silver lining at the margin is probably the chip cycle. So our tech analysts believe that the memory super cycle has started. So far it was mainly AI driven. Now we're also seeing recovery in the conventional server demand. So there is some offset from the chip cycle, but overall we do think exports in the region will slow further going forward.
That's so interesting, Sonal. That's really great. Thanks for coming back on the podcast.
Thank you very much, Andrew.
Now, let's not forget Japan, because there's a lot going on there. Over the coming week, we're tracking growth momentum as we move closer towards the LDP leadership vote on 4 October. Nomura's research team in Tokyo think that August industrial production data out next week could show a fall of around 1.2% on the month. If so, that would put production in Q3 down by about 0.5% on Q2. And they have GDP growth tracking negatively in Q3 as well, after 6 positive quarters of growth. The BOJ's Tankan survey of enterprises will also be released next week, and it looks like that one might be so-so as well. Our team think the diffusion index for large manufacturers likely rose by 2 points, but the index for non-manufacturers probably fell by around 2 points. And finally, to wrap up this week, I'm going to invoke speaker's privilege and shine a little light on my part of the world. So first up, New Zealand. It was announced this week that Dr. Anna Bremen, currently the first deputy governor at the Riksbank in Sweden, will be the new governor of the Reserve Bank of New Zealand with effect from 1 December. We see no implications in terms of the near-term path for the cash rate there. The Riksbank have a similar focus on inflation, and the governor is only one of 6 voters on the policy committee. Moreover, we only have to look back to the August meeting to see that voters are not afraid to dissent from the majority view. In New Zealand, we continue to forecast 2 25 basis point rate cuts at the next 2 meetings in October and November, and that's before Dr. Bremen's arrival. That would take the cash rate into accommodative territory at 2.5%, and we do think, despite recent weakness, that the stage is set there for some sort of economic recovery over coming quarters. And finally, Australia. We had disappointing news this week with a sharp jump in inflation pressures, particularly in services, revealed by the August CPI indicator. Combined with stronger than forecast growth in Q2, we think this suggests that RBA communication will pivot back in a less dovish direction at the policy meeting there next Tuesday, where we expect an unchanged cash rate to be announced in what may very well be a unanimous decision. Following that higher inflation reading this week, we withdrew our forecast for a 25 basis point RBA rate cut at the follow-up meeting in November. We have kept our call for a final 25 basis point rate cut in February next year, but we couldn't describe our conviction there as high, and we do flag some possibility that the RBA easing cycle may be over. Okay, so there you have it, our views on major market themes and what to look out for next week. This podcast has been written by Andrew Ticehurst and the Global Markets Research team and expertly edited and produced by John Dalton, as always. Thank you for listening in. If you did enjoy the podcast or would like to hear more, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud, or wherever you go for your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log into nomuraconnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision, and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.